Good afternoon to everyone. Just 1 minute. Good afternoon to everyone. I hope you are all fine and ready to take a course of today. I welcome you all to yet another session of taxation. We are today taking a formal start of the course. We people have met the last week to introduce this course and lot many things which has exhausted the whole time of the last week course. Without any further delay, without wasting time onto this and that, we are going to take a start of the course of today. Lots of things I have been able to inform you about the last week. Keep that in mind in regards to the progression of the course, in regards to the course contents, and some general guidelines, especially which I have shared to all of you people in the last 30-40 minutes of the course. You people are been aware of the whole plan. I told you that we will start the course from capital gains tax. So let's connect ourselves to the board so that we can have a formal start of the course of today. If anyone has joined me in between, you should be trying to watch the recording if so far you have not watched this weekend itself, because a lot of things that you as a student of taxation needs to be aware of, you probably have been missing it out because you have not taken the course the last Saturday, but you must be informed of all of that. So take a time out to watch it, the recording of the last Saturday course. It has been made available into a same cloud space. I even have a brief you on the last week where and how. This is the chapter 17. So if I go and take you exactly back to the list of chapters, where you will exactly see the highlighting I have done, that this will be the area we are starting a course with, the first one, and will take us around 5 to 6 sessions to finish. And within that section, the first one, as you can see, is the chapter number 17. We're taking a start of a course from. Good. That is chapter 17. The lecture notes of that are in front alongside the whiteboard explanations. Capital gains tax. The exam importance of this capital gains tax is somewhere in between 15 to 20%. Somewhere in between 15 to 20%. Not more than 20%, not less than 15. On average, 15 to 16 marks for surely will be there. Where in section A of the exam, by taking roughly 2 to 3 objective test questions, each we know that for 2 marks each. Whereas in section B, there's going to be surely a 10-mark question. One question that will be for 10 marks, that multitask question. You see, I've talked about this exam pattern thing the last week, but when I was talking about this the last week, I was talking about every area of the course. But because we are starting off with the capital gains tax, so I am restricting my explanation only to the topic of capital gains tax. It has one reason, that every time you will open the whiteboard explanation of capital gains tax, you will be able to look at it. And this will automatically give you a quick reminder of, okay, that 15 to 20%, that topic will be examined in section A and in section B for this much worth of marks. Knowingly, unknowingly, you will land yourself onto this page of your whiteboard explanation. If I go and take the last week exam pattern, I was explaining the same to all of you the last week. And if you now can see, the capital gains tax was one of the topic to fit into section B for 10-mark question. That's what I have been able to exactly write over here. And then few questions into section A, like 2 to 3. That's the exam importance of capital gains tax. Now, just to the point in relation to this topic, I have been able to write. So every time you will open this whiteboard explanation, you will be able to land yourself onto this page and will not forget that in which question of the exam for how many of those marks this topic is likely to be examined. What are we expecting to learn? Means if I have to tell you this topic, the scope of this topic, very casually, this topic is all about individual owns an asset. That asset that can be of any type. It can be a land, it can be a building, it can be a car, it can be even the shares and securities. Individual owns an asset. Later comes to sells this off to someone else, to whom it has been sold out to. It can either be an individual or it can even be a company. Not necessarily the buyer has to be an individual. It can even be a company. Means I own a plant, so I may sell that plant to another individual or maybe to a company. At least I have to be an individual owning that asset and selling it off. From the sale of this asset, I will be able to realize gains. And I will become then liable to pay a tax on it. That is called as capital gains tax. This is the basic theme of this topic. These gains are called as capital gains. Why? Because there has been a disposal of capital asset. Property, plant, and equipment are all what? The capital asset. So the disposal of such assets when will result in a gain, that is called as capital gain. An individual then will become liable to pay a tax on, which is called as capital gains tax. This is what you expect to see the next 5 to 6 sessions. Individual owning lots of types of assets, and while they dispose them off and getting the gains from, they will become liable to pay a tax on. That is called as capital gains tax. The assets that we are going to talk about are the fixed assets, not inventory, debtors, cash. Fixed assets, non-current assets. To define this topic in more of a bookish way, this is the definition of capital gains tax. So capital gains tax arises. There are 3 portions. I have been able to divide the definition of capital gains tax. Capital gains tax arises on the chargeable disposals of the chargeable asset by a chargeable person. Arises on the chargeable disposals of chargeable assets by a chargeable person. And this is where we need to understand the meaning of each word. And with the combined effect, the capital gains, it's in fact, you have got three parts of one of the definition. If all of those three parts being checked in, the capital gains tax will only arise, else it will not. If the two of the parts are checked, but the last one is not, capital gains tax will not arise. So any of the part is missing, the capital gains tax will not arise. Chargeable disposal. What makes the disposal to say chargeable? What makes the disposal to say chargeable? There are four possible transactions that will give rise to a capital gains tax. Number one, which is the more common one, the sale of the asset. Because this topic is all about selling an asset, disposing an asset. Gifting an asset will lead to capital gains tax also. Exchanging an asset will also lead to the capital gains tax. Or if it has been destroyed and that asset is insured, then you know that when an asset is insured, the business gets the insurance money on it. And that also will lead to capital gains tax. So we will come to see all of those cases with the time to come. But by defining the definition of that, I at least have been able to make the list of all of those events that upon the happenings of which the capital gains tax arise. The sale is going to be the most prominent event. Gifting an asset, exchanging an asset, and if an asset is destroyed, damaged, or lost, and it was being insured, all of these will result into capital gains tax. These are the chargeable disposals. Of the chargeable asset, all the assets are chargeable. All the assets are chargeable. All the assets are chargeable. Except exempt assets. And the list of such assets I can come to reveal in about next few seconds. Everything is chargeable except few. Suppose if I have 100 odd assets, almost 90 to 95% of those assets are chargeable. Some 4 to 5 will not be. So we must have to remember that 4 to 5, so that if I can know, I can just make them charge the rest. Because it's easy to remember the list of 4 to 5 assets in comparison to the list of 95 odd assets. So I can remember that these 4 to 5 assets are not chargeable. So automatically, other than these 4 to 5, everything is chargeable. Normally, everything is chargeable except few assets, and I can reveal the list of that in about next 1 minute. What makes the person to say a chargeable one? A person has to be a UK person, UK resident. And there is the way a person is classified as UK resident. We will have a look onto it in the later part of the course. Obviously, a UK born individual, UK domiciled, is by default a UK person. But even the expatriates, the foreigners, those they emigrated to UK, there is a criteria one has to satisfy before being called as a UK resident. We will have a debate onto that in the later part of the course. So a person has to be a UK person. Person cannot be a tourist. A person cannot be anyone who just goes to visit the UK for a short period of time. Has to do either of these 4 things. And the type of the asset has to be a chargeable one. If all of those 3 parts of the definition are satisfied, the CGT then only will arise. That is a definition which I have been able to make it easier for you by dividing them into parts. Each part has been well explained, and we can try to put some examples, pass through few examples to see if they are leading to capital gains tax or not. Also, how the same explanation back into our lecture notes being written. Let's check this out. You won't be surprised to see what's been there. Check this out. Arises on the chargeable disposals of the chargeable assets by a chargeable person. Exactly the same way, the whole of that definition being divided into these three important parts. Under the banner of chargeable disposals, you will exactly come to see the same four events: sale of asset, gift of asset, exchange of asset. Capital sum derived by the loss, destruction, or damage to an asset. Capital sum over here means insurance recovery. So, whatever you just have been able to learn, this manner, it's written and it's easily readable. See, these are my lecture notes. So, what I am explaining to you here, there will be a connection to what's there. That even I do not specifically come back to bring these lecture notes onto the screen, and you will try to look into it by yourself afterwards. You will be so comfortable. You will be like, okay, I know this, because that is exactly what the lecturer was talking about: the sale of asset, the gift of asset, the exchange of asset on his whiteboard explanation. Is it or not? Sale of the asset, gift of the asset, exchange of an asset in the case of destruction, maybe in the case of when an asset is damaged or when an asset is lost and it was being insured and you get the sum of insurance on. All of these events, they gave rise to capital gains tax, and there are four of them. Coming down to reveal the list of exempt assets. Everything is chargeable unless exempt. And this is the list of exempt assets that you have to pay attention to. Must to remember, let me write on top. Must to remember. Why did I write this must to remember? Because they do not have any concept or any logic that by applying it, you will have to remember. The only way you can remember that list is to keep on reading, maybe for once or twice. Every time you bring up that page in front, read that list. The number of times you will read, the more easy the life will become for you to remember. It starts off with motor car, including the vintage, classic, or any type of car, exempt. Motor car is the highlight, is a non-current asset, but not the chargeable one, the topic of capital gains tax. Investments into individual savings account, investments into national savings certificates, investments into qualifying corporate bonds, investments into government stocks. These four investments, remember it like, okay, there are four investments: individual savings account, qualifying corporate bond, national savings certificates, government stocks. These four investments are exempt. Other than current assets are totally outside the scope of this topic. It means, what does that mean when I say outside the scope? Means there is no connection. Outside the scope of. But this topic is all about dealing with capital asset. I already have said even before. So don't bring them in with the inventory, receivables, cash. It's totally not related. So outside the scope, current assets. Premium bonds and prize and betting winnings. So four investments. And other than these four investments, you have to remember the exemption like prize bond winnings, premium bonds, and cars. Cars can be of any type. How long will it take to remember? You do not have an exam tomorrow. Have the whole 4 or 5 months to go on. Once By taking the course of that, you probably have read. Number of times you will find the chance to come and read. But this needs to be remembered. As a student, you have to. Everyone has to do his own job. You yourself have to have this into your mind. Does not really matter how good the lecturer has explained or planned to discuss these things. Ultimately, at the end of the day, if you cannot keep that list into your mind, you will suffer on the day of exam. And I have told you how to remember it by reading it. Motor car, premium bonds, prize and betting winnings. So these three, you can remember it. And then, okay, there are 4 investments. One is in individual savings account. The other one is into national savings certificates. Third one is into the government stocks. The last one is into bonds, qualifying corporate bonds. Current assets are totally not nearer to this topic, outside the scope. Yes, you also probably can see this certain chattel thing. Forget about chattels. We will come to learn formally in one chapter, chapter 19. So if so far you're not so much being good on what is this chattel, don't even read that. Certain chattels are exempt, certain are chargeable. Which of them are exempt? Which of them are chargeable? What are these? Chapter 19 will have a detailed talk about this. Till that, you can defer it. Well, shares are definitely chargeable, may be unquoted shares or quoted shares, preference shares, audit shares, ordinary shares, whatever. Land and building, fixed plant and machinery, everything is chargeable. So land and building will take any type of building the business has, factory building, retail premises, administrative hall. You name any type of building, it will kick in. Same way, plant and machinery, any type. May it be a plant and machinery, may it be a computer or anything. Usually everything is chargeable with the exception of these 5 to 6 items. Like I said, 95 of those items are chargeable. If you can remember the list of these 5 to 6 items, just take them out. The rest, naturally, automatically, by default, chargeable. A person is said to be as a UK1 who is resident and or ordinarily resident in UK. So this we will come to work later on while we will step into the income tax topic. There we will be having a detailed talk in regards to who is a UK resident. Even if the person is not been born in UK, domiciled in the UK, still the person can be called as a UK person by meeting certain criteria, number of days of stay, number of visits to the UK in this way. Chargeable individuals, they are subject to capital gains tax on worldwide disposals. Worldwide disposals means both the local and the foreign asset. Local, here I mean to say UK assets within and outside the UK. So if I'm a UK person, I might have some assets abroad, must be called as foreign assets, foreign properties. So upon the disposals of such properties, I will be subject to pay UK capital gains tax. Whatever the tax in the foreign country I have to pay, that's not the talk right now. The talk is if I dispose of my any foreign asset, even in UK, I will become liable to pay a tax, UK tax onto that. And obviously, UK property has to be the one on which the disposal of that the UK CGT will arise. In our course, we do not have overseas aspects. When you will come to see me for advanced taxation, if you will opt as advanced taxation is an optional subject, there you will also come to learn overseas aspects, foreign properties and all. In our course, we only have those assets, those are within the UK. And if the person is a non-UK person, will become liable to pay no capital gains tax, neither on UK nor on abroad properties. So the rule is very simple. The person is a chargeable one, will subject to pay tax on worldwide asset. If the same person is a non-chargeable one, not subject to that property. By the way, in our course, the assumption is always that the person is a UK person. You will never be get yourself into that debate of that the person is non-UK. So the tech that I'm telling you, you will come to learn in advanced taxation. In your course, the assumption will always be by default that the person is a UK person. This is the definition, which in the start of the course is important. Not because later you will be asked to write, but good that the topic that you start formally, it starts off by defining it itself. Not the first thing that I should start off with is a pro forma of computation, which is what we are getting into, which is a main business part of this chapter, getting into those pro forma of computations. But the first thing is that to take a start within which we get ourselves familiar to what this topic is all about. And I haven't asked you to cram this definition. I rather have tried to make you understand that in this manner. This will make us to apply on this. Which of the following disposals may give rise to capital gains tax? In all of those parts, one of the assumption that I can make is that the person is a UK person. This is the assumption I can make, that the person is UK resident. Assumption, which is the assumption I'm telling you in the courses, we have to be taking it throughout. Randomly, I can pick any example: sale of the motor car to a brother less than to a market value. Sale of a motor car to a brother at less than the market value. Sale of the motor car to a brother at less than to the market value. First thing that we need to see what type of transaction he is into. He has been selling. The sale is one of the chargeable event. Now we will have to look into a type of asset, which looks to me an exempt asset. So he himself is a chargeable person. What type of transaction he has been engaged in is a chargeable event, but the type of asset he owns is not. So CGT in that case is not arriving. See, the application of definition. If I had just tried to cram it, I would have not been in a situation to apply it, because now you probably have understood by this time that how the way this definition has to work. So you can apply it with and decide it. This is going to give a rise to CGT. This is not going to give a rise to CGT. Exchange of a house for an apartment with a friend. Exchange is one of the chargeable event. The type of asset looks to me also a chargeable asset, since land and building of any kind is chargeable, may it be a factory building, office building, administrative hall, personal house like this one, private house. And if myself is a chargeable person, so this will definitely give rise to a capital gain, because of what I have done, the type of asset that I own, and myself is a UK person. All three parts of the definition are being checked in, will definitely give rise to a capital gains tax. Sale of the shares in an unquoted trading company. Selling is a chargeable event. The type of asset that I own is unquoted shares, which is a chargeable asset. And myself, because it's a UK person, definitely will give a rise to capital gains tax. Gift of a Liverpool flat by an individual who is neither resident nor ordinarily resident in UK. Now, gifting an asset is a chargeable event. The type of an asset I own is again a property, land and building, flat, house, apartment, whatever, chargeable asset, but myself is not a chargeable person, who will not give rise to a capital gains tax. Three parts, all like a checklist have to be checked. If one of the thing in the checklist has not been checked, capital gains tax will not arise. Gift of a painting or sale of the treasury stock Selling is a chargeable event. The type of the asset I own is a government stock. Treasury stock is a government security, and government security is an exempt asset. Therefore, will not give rise to a capital gains tax. Gift of an antique painting. Now, gifting an asset is a chargeable event, and the painting could either be chargeable, could either be exempt. This is a chattel. So, like I told you, we will have a debate onto it formally in chapter 19. This painting can be taxable, this painting can be exempt. We will have to explore it more. But on the assumption, if it is chargeable, then this will give rise to a capital gains tax as it has rather been gifted. This is the first page of this topic. And tell me, if anything on that page that's been written and I have not looked upon, or I have not completed, or I have not touched, that pretty much ends up the definition of capital gains tax. Now you will never forget. The way it has been explained, you will remember it. If it only was the case that I had asked you to just cram this, you probably have taken a minute or two to remember it. And then it's of no use. Just to remember it, capital gains tax arises on the chargeable disposals of the chargeable asset by a chargeable person. Call it for 10 times and cram it. But it is of no use if you do not know the chargeable disposals, what sort of chargeable disposals, what sort of assets those are chargeable, and who is that person who is liable to pay a tax. Every part of the definition has been further explored. And then this has made us to apply this to application to decide which one is giving a rise to CGT and which one is not. Let's get down to the major, or I would say the business part of this topic, which is this, a pro forma of the capital gains tax liability computation. This is from where now we are starting off the main business part of this chapter. Main business part of this chapter. Let's try to look onto this pro forma from the top to the bottom, like a picture, and then we can start working onto that one by one. It starts off with gross disposal proceeds. Next to that, we have incidental cost of disposal. Then we have cost of acquisition, incidental cost of acquisition, enhancement cost, some reliefs and exemptions, followed by the capital losses, the current year, the brought forward. Then in the last, some sort of exemption to make those gains taxable, and then ultimately with the application of the rates of taxes, the liability of capital gains tax will be found. This pro forma does not need to be crammed because we are now here to learn it part by part. Naturally, it will be remembered. So just don't sit and start cramming it. By the time the course of today will finish, you will be able to remember every bit of it. This chapter is titled as Basics. So you will get to know how to compute it. But then this pro forma will not go anywhere. All those chapters we have planned to cover on capital gains, chapter 18, 19, 20, 21. Every chapter will come back to make the use of this pro forma. So this pro forma, although is a basic thing, but it will not go anywhere. It will be every question that will require you to compute a capital gains tax, you will be having no other way except to prepare a pro forma and work that answer. So don't take it lightly. A separate pro forma is made for each and every asset that is disposed. That we also can have a look. If you have disposed 2 assets, 3 assets, 4 assets, must have to prepare a separate calculation for each of the assets. because every asset will have its own proceeds, own cost and facts and figures. So you must have to maintain a separate pro forma for each and every asset that has been disposed. The lecture notes are written in a same sequence. As you can see on the top, the first component is gross disposal proceeds. And we are starting to have our words from that one first. And it will follow the sequence. Gradually, the discussion of incidental cost of disposal will come in, cost of action will come in, then the losses, current year, and brought forward. So the lecture notes are written in the same flow as this pro forma, top to the bottom goes in. So starting ourselves with gross disposal proceeds on the firm. Let's do a board work, and then we will get back to look into the lecture notes in some time. Usually it takes cash. Usually takes cash, but there can be some other possibilities. We have to prepare ourselves, but usually it takes cash. See the example. Hypothetical examples, illustrations, I will keep on preparing it a lot on the whiteboard explanations. So suppose Mr. A has disposed an asset to Mr. B for £50,000, which was acquired previously for £27,000. See, just a random facts. So because it's being purchased for 27,000, I just have to come and write the balance of proceeds. So what am I supposed to write? The proceeds and all. What am I supposed to write? Sale proceeds minus cost. Usually it takes cash. Now see, Mr. A has disposed of an asset to B for 50,000. So what is this 50,000 over here? Well, what is this 50,000 over here? Cash. It's the cash that the party has paid to me. It's the cash that I have received from that party. And this is what we are supposed to write it down over here. So it's proved that usually being the part of gross disposal proceeds, what we are going to write is the balance of cash. Is the balance of cash. Is it? Sale proceeds less the cost and the gain. So it was too obvious, but still early days of the course. And I cannot take a risk of making an assumption sometime that it's too easy. And even without I make this, you would have got it. May have not, you may have not. Some of you might have picked it, some of you might have not. So I do it everything. And the second reason of doing this is that when I'm going to bring some possibilities in, then you will be able to contrast it, this normal case to that one special case. And then you will be able to say that out. Yeah, the only difference of this case to that one is this thing. So Mr. A has sold an asset to B for 50,000. That for 50,000 is in fact the balance of cash, which is what one has to consider it being the part of sale process. Now let me go and make another case. Check this out and see by how far it is going to be different. from the one we have just done. You will immediately be able to see the difference. So let me rub off those figures. And let's try to change the little bit of the facts. Mr. A has disposed. No, let's go and change that too. And that is the second possibility, because gifting an asset is also a chargeable event. Let's not forget sale, gift, exchange, or destruction. Instead of disposal, it was rather being gifted to B. This definitely I have to change because gift is without a consideration. So for 50,000, I definitely have to change it. Rather, I can write Mr. A has gifted an asset to B when the market value of an asset was market value of an asset was 45,000, which was previously being acquired for same. So I'm not going to change the cost and all, but just I'll be able to bring the change of proceeds to market value in it, because when an asset is gifted, definitely there are no consideration. There is no transfer of cash. It's rather the market value that we can just think of that, okay, on that day, the market value of an asset was 45,000. So I will still come to record the cost as above. Actually speaking, I should not be writing anything over here. Is it? Because actually there is no proceeds. Neither B has paid anything to me, nor I have received anything from B. So actually speaking, it should not be writing anything. But as far as the computation of capital gains tax is concerned, we are required to use the market value instead for the sake of computing. For the sake of computing, we are asked to. Now compare this case to the one that I have worked before. Here we have used the cash. Here we have been able to use the market value. And now you can see the difference of what here the asset was disposed, which in this case was rather gifted. So if I construct only this case and not this, you might not be in a better position to compare the two. Now you can compare it and see the difference of these two examples exactly live here. Disposal, proceeds were involved. Gift, proceeds were not involved. So what have we taken? Proceeds. What have we taken? Market value. So in the transaction of gift, market value will be the deemed proceeds. Deemed means assumption, that we have been able to make an assumption as if 45,000 is the price someone has paid. So I have been able to write it, which in fact is the market value of an asset on the day an asset was gifted. Good with this? We have no choice but to take market value. Let's go to make another case. Let's copy and paste this entire story to make another case on that, which means another possibility might exist. Mr. A has disposed an asset to B. Let's change that to son. Let's change that to son. Now that is a change. I'm bringing it in, although it's still disposed, it's not gifted. Case by case, how easily you will be able to sit back and revise it from my board explanations itself. When these are handed over to you in the PDFs, you open that out and page by page, you easily read and move on to the next page. And you start getting to know the whole flow of explanation. And you can easily compare those illustrations from one to next and the differences of. So what sort of change am I going to bring it in front of all of you? I'm doing this whole editing. Let's try to bring this line to somewhere over here. When the market value of an asset was 65,000. So Mr. A has disposed an asset to son for 50,000 pounds when the market value of an asset was 65,000, which was previously been acquired for. So I have not changed the cost throughout because the discussion is not on the cost. The discussion is on the proceeds. So there I'm bringing a change into it. According to our explanation of ours, when an asset is disposed, we have to come and record the cash to be the balance of proceeds. So just go and do the same. The cash is 50,000. So if I have been able to use the cash over here, you should be having this thing into your mind coming that what has been the difference of this solution to the one that we have prepared it above then? What is so special about that we have been able to create another example of the same kind? So start getting to know. See, the difference over here is now this one. The asset has been sold out to a connected party. Connected party means family member, son, daughter, brother, sister, wife, father, mother, children, which has not been the case over here. Two random person, Mr. A does not know who is B, just the buyer and seller, they are to each of them, not the family member. So the difference, first of all, lies over here that Mr. A sells off an asset to his son for 50,000. When the market value of an asset was 65,000. And this is creating a trouble. If the market value was 65,000, that why was that being sold for 50 then? Should have been sold out for 65,000. This is the concern. The tax authority will show that, okay, if the asset was being there in the market for 65,000, then why was that being sold for 50,000? It should have been sold for 65,000. But it has not actually been the case. And practically speaking, it happens. You may have experienced this in your family around also. While you sell out an asset to someone that you're close to, you do not really wanting to make the profit out of that transaction. You rather try to sell it and give a favor to a buyer, whoever is in the family, wanting to buy your asset. Is it like that or not? Sometimes you do not add anything, you just give it away, gift. But there was a sale transaction. Rarely the asset was sold, but then it has been sold at the price that's way less than to the market. Because one can understand that the father is trying to give quite a bit of a favor to his son in selling an asset out at the price that's way less than to the market. He would have never done that if the Mr. B was involved, because Mr. B, he would have been wanting to make more and more profit out of it. Is it that or not? It happens. If I have to sell an asset to someone that I do not know, I will try to get as much as out of that transaction. But imagine I try to sell the same asset to my sister or to my brother. I will be like, okay, take this asset away. Pay me whatever the price that you would wish to pay. No matter after a month or two, there is no emergency. This is the behavior that we have when normally we try to sell out the asset to our closed ones. That take this asset away. When you have a money, give it to me. And then whatever the price you would wish to pay me, just pay me. I am not demanding anything specific from you. Or even you do not wanting me to pay, fine, keep it. This is the kind of behavior when we sell off an asset to someone else into our family members. But when we sell it off to someone else that we do not know, outsider, we definitely would be wishing to make a lot of profit out of it and all, which has been the case right now. As a result of this, what has happened? Since the price that has been charged is way less than to the market, this also has reduced the gain. And as a result of that, taxes are saved. Lower the level of gain that this person will have, the lower the tax that this person will end up paying. And tax authority, they will mind it. They will mind it. So they will be wanting us to make an assumption. Whatever you do, actually, do it. It's your transaction, it's your family. You make a loss out of it, you make a profit out of it. Do whatever you want. It's your asset, it's your transaction. But when it comes to the computation of capital gains tax, market value will be used for the sake of computations. Market value will be used for the sake of computations. So I will replace all of those actual figures to the deemed figures. 61, 5,000 minus 27 now will give me 38,000, which is the gain that now we have worked based on to market commercially. This should have been the amount of the gain if the asset was sold at the market value would have made out of it. And this guy will end up paying tax based on to 38,000, not 23,000. So actually, whatever they have done in selling it out, do it. It's your asset, your property. You wish to sell it at a loss, you wish to sell it at the lesser price. But when it comes to the computation, actual proceeds will be replaced with market value, so that the gains should be worked according to market. That is another case within which market value will be the balance of deemed proceeds. Deemed means we are assuming actually it's 50,000, but we have assumed as if it was 65,000. That much of a talk was required for this. And I have done it by spending the past 30 minutes or so. Every little thing to understand, there's going to be an illustration. Many of them I will be creating it live in front of all of you. And you probably have started sensing it the way that the course has to go on, the way that the taxation course has to learn. A lot of examples to understand the different possibilities. Basic thing is this, which is going to be the part of almost every question, but exceptions are there, and those exceptions I have been able to explain. Two of those exceptions. At the end of all, let's go to see the way back into lecture notes, how this whole story has been written. Check this out. Under the banner of gross disposal proceeds, in the first place, they even have suggested usually consists cash. But yes, the market value is important in some scenarios. Exactly two scenarios that I have explained that to you already, mentioned over here. When asset is gifted, or when an asset is sold out to a connected party. Because in that case, the tax authority will be wanting us to assume market value instead of proceeds. I'll come to show to you of this connected party chart, which so far I have not explained. This is the whole way the lecture notes are written. And if these explanations are not being backed up by these illustrations, my live course explanation, you would have no chance of reading these lines and understanding it. Else you will try to just read it and will be trying to cram it. So these lecture notes, they also in their own cannot make you pass this exam. Actual thing is that my live course presents this, and this. All 3 points, those are being just written. Give you the proper explanation of that. Okay, what do they mean to say when I say usually takes cash? What does that mean when asset is gifted? What does that mean an asset is sold out to a connected party? You've been given a very nice explanation of that. And your job, especially in early part of the course, is just to revise it. adequately whenever you find the time to do it. Now, in connection, a lot of connected parties, those are around me, and we will take them into consideration. The chart below shows the connected parties to whom the taxpayer is in connection to. Spouse of taxpayer, husband to wife, wife to husband, or civil partner. And then children, grandchildren, parents and grandparents, siblings, and their spouses. Spouse, siblings, and their spouses. But more common into our exams are those are quite close to each. And we can immediately label them as connected parties. For example, in your questions, brother, daughter, father, son, mother, wife, these will be used. And you will not be confused about if I have to take them into connection. They definitely are your connection. I'm not talking about third cousin, fourth cousin, fifth cousin, uncle, aunt over here. I'm talking about mother, father, son, daughter, brother, sister. These are the 4 to 5 parties that you're going to find into your questions that you will never be clueless about to call them as connected parties or not. Good with that? After so much of hard work, finally, we can move on to the next one. And that is incidental cost of disposal. What is that word? Incidental. This cost is incidental to sale. This cost would have not been incurred if the transaction of sale is not taking place. I can quote some examples. Delivery cost is incidental cost. You would not incur a delivery cost if this asset is not sold. Because it's sold, so now you have to deliver it and will pay a delivery charge. It's incidental to sale. Discount is a cost of sale to a seller because discount reduces the sale price. So it's a cost to a seller. And as a result of sale, this cost is incurred. Agent commission. You ask an agent to help you in selling your asset. Then upon the day of the sale, you pay a commission to that agent. This cost of agency would not incur if asset would not be sold. Auctioneer fees. The properties. Most of them, they are sold by the way of auction. So that whole activity of auction being conducted for the reason of selling an asset, not in normal life you do it. These examples that I'm giving to you, you are sensible enough to even understand that, okay, what this incidental cost is about now. Any cost that you expect to sell or you have incurred in achieving that sale of an asset is called as incidental cost of disposal, and one has to deduct this out of the gross to arrive at net disposal proceeds. This is it. Not every component requires to have a talk like we have had on to gross disposal proceeds. That was a main component. Check this out. Incidental cost of disposal. They are going to take the same examples as I have explained: estate agent commission, valuation fees, auctioneer's fees, legal fees, advertisement cost, delivery cost, discounts, and many more costs of this kind will fit in that makes the sale possible. Easy to read. Not the paragraphs and the paragraphs of explanation are there that makes the life of yours difficult or boring to get into when you feel lazy about reading. And after my explanation becomes easy to read. That's what I'm telling you. If before I had to explain this, if you had been asked to read this, you would have not paid even importance to it. But now, after I have explained this whole thing to you, after that, when you come down to read it, you feel it like, oh, it's already understood. I'm okay with that. So first I do a board work. And then to make sure that we are covering it off everything into the lecture notes for your confidence, I come down to show to all of you onto a screen that this is how the way things are written back into lecture notes. Have a look at it. Where we are landing it towards now, cost of acquisition. Check the pro forma out. We already have completed the first 3 of those rows, and this makes us to land ourselves onto the cost of acquisition. Now, this will require to have again a bit of a debate. Let's do it. A paper work. Cost of acquisition still required to have a detailed bit of a talk, like we have had it on proceeds. So let's do it. Cost of acquisition. And even here I can write it. Usually takes what? Purchase price. Usually takes purchase price. Usually takes purchase price. And to make an example, and to understand that out, let's go and make one more example onto it. See a case where there has been 2 parties involved, Mr. A and B. Let's assume ourselves as Mr. B. There has been an asset being disposed by A to B, and we are the one buying that asset. B is us, and we are the one buying an asset. So this asset, when being sold by A, it was being sold out for 10,000. Whatever the cost and all, we are not interested in computing the gain for Mr. A. We have to be assuming ourselves as Mr. B and buying an asset for how much? 10,000. So if A collects 10, B pays the same. This is that 10,000. The B has paid to A and A has collected. So what do we call this 10,000 as? It's a price at which the asset was purchased at. Purchase price. It is a price at which the B has acquired this asset previously at. When I say, I don't mean to say literally tomorrow, Sunday. It means in future, whenever this will be disposed by B to someone for no matter whatever the price, randomly I'm taking those figures, 70,000, what should be the cost of acquisition I will end up using? I will go to check that, okay, this asset was acquired by me in the past for 10,000. This is the price that I have paid when it was acquired. Should turn out to be the balance of cost of acquisition for the sake of computing the gain. So cost of acquisition is usually the price previously paid to acquire it. Again, it's a very obvious thing. Some of you might have been wondering, okay, what's so new in it? But again, because now we have got some variations coming to our way. So to understand those variations, the basic case has to be gone through first. That this is basic case. I'm Mr. B, selling off my asset to someone else today for 70,000. So I have to see when this asset was being acquired by me in the past, what was the price did I pay? Which turns out to be a cost of acquisition today to compute the gain. So it usually takes what? Purchase price. Convinced? Instead of this, if I go to change this transaction to this transaction, Mr. A Let me try to copy and paste this whole situation so that you exactly can spot the difference where the difference is coming to our way. Instead of disposal, let me change that word to gifted. Asset being gifted by A to B. And the market value of an asset on that day was 9,000. That means for the sake of computing the gain on Mr. A side, let's not forget we will have to take market value. You cannot be forgetting this because I have explained that to you nicely well when an asset is gifted. So being the part of proceeds, we end up using the market value. So this asset was rather gifted by A to B. So on his own side, market value had been used to compute his gain, which we are not interested in computing. As a result of this, for Mr. B, the cost of that will turn out to be 9,000. How come? Neither of the party has paid 9,000 nor has received. But when we have made an assumption on the side of A, as if this is the proceed the A has collected, so we will have to make the same assumption on the side of the B as this is the price that the B has paid in acquiring. Well, the truth is neither of the party has paid this nor any has received it. But like a sale transaction, when you consider the sale proceeds on the one side, you consider the cost price on to the other side. Same, we have been able to use it over here. And it's all assumption work. If I'm assuming to be the balance of proceeds on the seller side is 9,000, the same assumption should continue on the side of buyer to be the cost of purchasing an asset. And tomorrow when this asset will be sold by B, B will end up using the same 9,000. Using the same 9,000. Which means this time the cost of acquisition that we have used is in fact the market value of an asset on the date of gift. On the date of gift. So what is this 9,000? Is in fact the market value that was seen to be the market value of an asset on the date of gift. Actually speaking, this side should not take anything because B has been bestowed with that asset. He never have paid any price to acquire it. He was rather gifted. He was blessed to have this asset with him without paying a single penny onto it. And as a result of that, nothing should even come over. But this is where you need to understand what we are applying. We're making the assumption when this has been an assumption of proceeds on the side of A, that will continue to be an assumption on the side of B as a cost of buying an asset. It means you have to balance both the sides. Just the way you balance the two of these sides up there, you also have to balance both the sides. And then tomorrow, the same assumption will even continue to be the part of cost of acquisition for the sake of computing his gains. So to conclude, the cost of acquisition can even at times takes the market value of an asset as a result of gift previously, because this 9,000 has been carried forward from the date of gift and it's coming along all the way to this. Check this out. When an asset was purchased previously, so one has to definitely take a price that's been paid for an asset. That's a normal case. But when an asset was received as a result of gift previously, then we must have to take the market value of an asset on the date of gift. Again, if you will just read it out without having this sort of illustration to back up with, you will remember, you always will remaining to be confused that what is going on, what does that mean, market value and all. But when you have got this case in front, still have a better chance of understanding. Still, if someone is struggling to understand specifically this case, then take yourself back to a normal case. A normal case is when an asset was sold actually by A to B for 10,000. So proceeds on the side of seller turns out to be the cost on the side of buyer. And that is happening exactly over here. If I am assuming the 9,000 to be the proceeds on the books of seller, the same assumption will continue into the books of buyer. But in reality, we know neither the Mr. B has paid this amount, nor the Mr. A has received this amount. It's all deemed. And then this 10,000 later was used being the part of the cost of acquisition. So why not? We also can use this 9,000 being the part of cost of acquisition, which actually has been the market value of an asset on the date of the gift, which we've been able to use it being the part of cost of acquisition. Good enough. So possibilities are there. You cannot just be good onto that one side and bypassing. Normally, every case that you do have got exceptions to deal with, and we must need to cover them off. And I'm doing my best to make examples to make you clarify. Probate value is the case of it. Hardly any difference. Does not require to make me one more example onto it. Imagine the same asset was gifted on the death of Mr. A. Gift on the death is called as inheritance. That's only the difference. Gift in a life is called as gift. Gift on the death is called as inheritance. But at the end of the day, it's a gift. So the whole process of dealing it with will not change, except we rather call the market value of an asset on the day of death as probate value. So probate value is a market value of an asset on death. So it's rather called as probate value. Otherwise, there's no difference. So these two cases are same. The way that I have explained this to all of you, everything remains to be the same. Instead of calling it as market value, you can have to call it as probate value. Probate value. PV. The value of an asset on death is called as probate value. That's only the difference. Otherwise, as far as this whole process of working the answer is concerned, nothing will change. So that ends up the talk of cost of acquisition with all those possibilities to come in. Incidental cost of acquisition. Just the way I have explained to all of you this incidental cost of disposal, same way this will work. Any cost that the individual has incurred at the time when an asset was acquired, for example, transportation cost, any sort of legal cost, any sort of taxes, will be added up as it's incidental to the acquisition of an asset. This cost would have not been incurred if an asset was never acquired. Well, just the way in your accounting courses, you come to treat any sort of enhancement expenditures, you still have to. You're actually capitalizing it. Don't you capitalize the cost of enhancement, improvement, extensions in your accounting studies into the existing cost of asset? The same it will be the case for tax. If you have a building which now has been enhanced because you've constructed further 2 stories on, so constructing the 2 stories will be topped up into the cost of existing 5 stories. But repair and maintenance cost you cannot take, because you have to remember the basics of accounts. You cannot expect to capitalize the repair and maintenance cost enhancement expenditure, extension expenditure, improvement expenditure will only be. And that's what's been written. Nothing much is there to talk about because it's something that does not have anything to learn further. What we have done so far, we have got two applications being lined up to revise before we take ourselves to the rest of the part of that pro forma, like reliefs and losses, current year, the brought forward. We've got two questions and we can work them up to revise what we have just learned. The application 2 requires us to work the capital gains on the sale of the house. On 1st of July 2022, Sam sold the house to her sister for £35,000. The market value of the house on that day was 80,000. Sam had acquired the villa back in 2016 for £29,000 and had paid the legal fee on the acquisition of £800. The estate agent for the fee for the sales total £5,000. And on the 1st of Jan 18, he added an additional room at a cost of £15,000. See, the question provides almost with everything. So what we can do for the sake of working an answer, I can just rewrite the whole pro forma so that I can simply punch in the figures when those are required to be, starting off with gross, disposal, proceeds, incidental, cost, cost of acquisition, incidental cost of acquisition, and then enhancement expenditure. So the whole pro forma, as it should be, I've been able to copy and paste. Just need to plug in the figures into it. Starting off with, Sam had acquired the villa back in 2016 for 29,000. This is the cost of acquisition, so I have been able to write it. Then comes the incidental cost. He paid the legal fee on acquisition. Now, legal fee on acquisition is incidental cost of acquisition. Need to write it in. And then they say that estate agent fee for the sales total, estate agent fee for the sales, that's incidental cost of sale. And then they also have added a room, which is definitely an enhancement, not repair and maintenance. So I will definitely go to capitalize this in, which means I will go to subtract it from. The only one last thing that's been left to fix it in is the balance of proceeds. And what are those? 35,000. And here you will have to remain alert on something which most of the students, they forget, both while they prepare and especially on the day of exam. And that thing is what you probably have noticed or probably have not noticed. When I was reading the question, I did notice one thing that now you probably have started noticing. Didn't you see me highlighting the word sister out from nowhere? Nothing in this whole thing was highlighted except this word. And sister is in connection to all of us, a connected party. And there the rule of that connection will come into play. No one will knock the door. You by yourself have to wake you up. While you read down the facts, you have to keep your eyes open and watch it. To whom an asset being sold out to? Who is Sam to buyer? Brother and sister. Connection. And in connection, a care is required. Proceeds we cannot use. Market value we have to, for the sake of computing. And see the same problem. This has been the market value of an asset and being sold out for peanuts. Less than even the half of the 80,000. The half of 80,000 is 40,000. Massively, this will bring the level of gain down and taxes will be saved. An authority, they will not accept that. So to prevent this to happen, they have made the rule for us to follow. And that rule is, no matter what you do, actually, that's your business, that's your connection, that's your family. But when it comes to compute the gains, market value will have to be used. Intentionally, I have done this so that whenever in the live course and later you will come across to this question, you will pay attention to that. The why the lecturer is writing 35,000 in the first place and then canceling it out and changing it with this 80,000. You will have a bit of a pause over here. And then you will suddenly realize, oh yeah, he was talking about this connection thing. And I also have to remember it. If I had used 80,000, you may have thought of these are the cash proceeds I have taken. Happens. I've seen that the students, they don't pay attention to, they feel it like, okay, 80,000 must have been the balance of proceeds. 80,000 minus 5,000. See, this is a small thing. If you will respect, the marks are yours. And if you do not, you will lose it. Simple marks with this simple thing. I mean, we have not even started off with any technical aspects. It's just the first day of our course. We're dealing with basics. So if these basics are even starting to trouble you, what you will expect to in all those tougher times to come? Pretty much the end of this question. Good with that? Everything was given, have been plugged in, except the one thing we had to show a care towards is this one point. Let's go and work the application number 3 to see what this has to offer. They want us to calculate the capital gains arising on the sale of both the assets. So now we have 2 assets with us, and I will prepare the 2 columns next to, because for every asset that they dispose, have to make a separate pro forma for it. John sold the house for 100,000 on 15th of June. It cost 45,000 in Jan 14 and was extended that out in November 17 at a cost of 17,000. The estate agent and the solicitor fee for the purchase total £1,500. Yeah, in relation to purchase, it's 1,500, and in relation to sales, it's 3,500. He also have sold the grandfather's watch for £20,000. He had inherited the watch on the death of his grandfather in December 2020 when the watch was worth £13,000. Okay, so there are 2 assets. One is watch, the other one is the house. So I can solve this question by, first of all, at least I can copy this whole narrative so that I can save a bit of a time onto it. And then next to that, I can just make the 1 column for house, and the next one for the watch. And then we will be able to find the totals of both the columns by adding them. So house being sold for 100,000 was being costing 45,000 has been the cost of this house, while extended it at a cost of 17,000. The incidental cost for the purchase total 1,500, and for the sale, no, purchase total 1,500. For the sales, it's totaled as 3,500. So it looks to me like the same question is above. And he sold the grandfather's watch for 20,000. How come? He has, did he purchase this watch from his grandfather? No, not been a case. Does not look nice, the grandfather selling the watch to a grandson. Probably the reason of inheritance. Exactly. He had inherited the watch on the death of his grandfather in December 2020. And the market value of the watch on the date of inheritance was 13, which should be called as the probate value of the watch. And the one we're going to use it over here. Although the truth is the grandson, the name of which is John right now, has not paid 13,000 to acquire that watch. It was inherited to him. And on that day, the inheritance, the market value of the watch is assumed to be the cost of buying an asset for him, which is what I have been able to use it over as a cost of acquisition. The truth is he hasn't paid even a single pound. He was rather inherited with that. But we must have to make an assumption of probate value. All after that explanation, we've been able to apply it. So that should give us the total of 7,000. 100,000 minus 3,500 minus 45,000 minus 1,500 minus 17,000. The figure turns up to be 33,000. So do we have to add up the figures? Do we have to find the total of that? I mean, even without using a calculator, I can tell you this is 40,000, but do we really have to add them? Yes, we have to definitely add them because the assets being disposed by the same person. So it must have been the gain of same person, and one has to find the total of whatever he or she has made. But this also depends upon one important thing, which now I can come to finally add. See, there is a tax year. Tax year. There's a tax year. The basis of assessment for individual is tax year. Just the way we have accounting year, financial year starts on some day, ends on a year after. Same way, the tax has its own year, which has a specific start and it ends on specific day. The tax year that is applicable to our exam attempt, we know that we are into Finance Act 2022. So for this Finance Act, the tax year that's applicable to all of us is tax year 22-23. This tax year starts on 6th of April. 6th is the fixed date. 4th is the month of April, fixed month. And because we are into Finance Act 22, so it starts on 6th of April 2022, which definitely will complete the whole 12-month cycle on 5th of April 2023. That's the reason why it's called as tax year 22-23, because it starts in 22 and ends in 23. 6th of April, you can't just write this to be as 1st of April, 3rd of April. 6th means 6. It's a tax year. It has a specific start and end, so you have to respect it. Month is the month of April. Year is 22, so it will definitely end on 23 then. It's called as tax year 22-23. It's not written over here, it's written somewhere in the other part of the lecture notes, but the need of this to understand that is over here, so I'm just doing the bit of a paperwork on it. Yeah, in some part of the lecture notes, I can take you to where it's exactly being explained, being the part of income tax. As you can see onto my screen, chapter 1. There in income tax basics, it must be there on the first page of that. Check this out. Starts on 6th of April, ends on 5th of April. So because we are into this Finance Act, so it starts on this day, ends on this. So it's called as tax year 22-23. Being the part of income tax basic chapter, first chapter, it's been formally explained there. Okay, so how can I say the gain that I have worked belongs to this tax year, simply one thing needs to be done. Check the date of disposal. What is the date the asset was being disposed at? 1st July. So let's write it. The date of disposal for this one is 1st of July 2022. And our tax year starts on this date, ends on this date. We just have to come and see if the date of the disposal belongs to this or not. If it is, then this gain will be assessed into tax year 22-23. Just that needs to be done. Same if I do that for the house and a watch. The house has been disposed on 15th of June 2022. And so is the day for the sale of the watch. Yeah, both disposals they have taken on same place, same day, 15th of both the disposal transactions have been taken place on the same. The disposal date right now is 15th of June 2022. So I will go to record this in this tax year, and so is the case with this one. So now when I'm being confident that both the gains they belong to same tax year, then I only can add the both. Else I will not be able to. Because it can happen in one question there are two disposals, but one belongs to previous tax year, the other belongs to this tax year. Then how can I go to add the both then? Understanding or not? See, luckily in this question, both the disposals are into same tax year. So we have to add them off to say that, okay, the gain for this tax year is 40,000 total. But can happen, house may have been disposed in previous tax year, watch has been disposed into this tax year. Then in that case, we do not have to add them both. That was the reason why I was stopping myself not to add them in first place, which eventually I have been able to add now. Just because of this tax year debate on the way, we had to do it, which we have been able to. So far, so good. The part of the pro forma that we have finished, we've been able to work two questions onto that even. And you people have seen the way that this pro forma has to start and finish. The time has come up that we're going to take a break for 10 minutes. Once I will resume the session, we will march towards to the second half of this pro forma. So stay tuned, do not go anywhere. I will see you in about 10 minutes to resume the session. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. So let's straight away get ourselves back to where we were, starting off with, what we see on the next were leaves and exemptions. And this is the part we will be discussing later in chapter 20, not today. And I also have specified the same even on the top of this page. Whether leaves and exemptions on the sale or replacement or the gift of asset will be discussed later in the notes. And that later is chapter 20. It comes down to the losses. Current year and the brought forward. So let's understand before we look back into lecture notes. What is it? How to work them in the first place and then how to relieve it. Capital losses, current year and the brought forward. Let's go to create the case number 1 under the banner of capital loss. This is asset 1 and this is asset 2. And we are trying to find the figures under the both. Now, you people have seen the whole process of working that answer. So we know what comes in the body, sale proceeds minus cost and all. So after doing that, suppose this column has produced a figure of 1000. And this body, this column has produced the total of 300 negative. Can happen just the way in accounting studies, while you prepare a profit and loss, the figure turns out to be a negative one and start calling it as a loss. Same can happen for the capital gains. So this is, first of all, is called as capital loss. And because this loss has arrived in a current tax year that we are in, so it's called as current year capital loss. In which tax year are we in right now? 22-23. So if the loss has arrived into that tax year, will be called as current year capital loss. What next? Needs to be relieved against the capital gains of the same tax year. So I will have to try and relieve it against the capital gains of the same tax year. This has been the capital gain of the same tax year. To find me an overall figure, which turns out to be a figure of capital gains, which is called as net capital gains, will form the part of tax year 22-23. So that how simple is it? You have a loss in the one column, you try to offset it with the gain of another one. And see, the overall answer has turned out to be a positive one. That is called as net capital gain. But in the case 2, things will slightly be different, as I'm going to create a situation where we have an overall loss. Then what we will be doing? This is case 2. And let's rub off these figures hypothetically. So this is case 2, where this figure is 2000 negative, and this figure is 17 or 1600 positive. Once again, should be called as capital loss and current year. as this is the loss that has arrived in the current year that we are in, so should be called as current year capital loss. And we just have to do the same that we have done. We will try to offset it with the gain of the same tax year up to the extent the availability of the gains that we have, and that is only by 1600. So the portion of the loss that we've been able to relieve and the portion of the loss that we could not possibly relieve, this is called as capital loss, but the brought forward one, because this now will be carried forward to offset it against the capital gains of the next year. This one will be carried forward to offset it against the capital gains of the future tax years. Now, how many number of years the loss can be carried forward? That is for infinite number of years. That will be for the infinite number of years. Carry forward to offset it against the capital gains of the future tax years. Infinite. But making it show that you offset them against the capital gains of the future tax year, not against any income. So how this will be carried forward? We have a question where you will be able to see how will it be carried forward and relieved it. But the rule of law says throw it into the next year and relieve it against the capital gains. How many number of years we can throw that in? Indefinite. Infinite. That is a discussion of brought forward and current year capital loss. Current year capital loss is the loss that has arrived in the current year that we are in, and we will have to offset this loss against the capital gains of the same tax year. If we have an overall gain, that is like a normal situation, but if we have an overall loss, that the loss that we have found is called as brought forward capital loss, and we have no way but to throw it into the next year. See, the loss that arises in the current tax year is known as current year capital loss. Must have to offset it against the capital gains tax of the same tax year. And then we come to carry it forward for indefinite number of years. The loss of previous tax year is known as brought forward, the one that's been carried forward from the last has to come and relieve it by carrying it forward for the indefinite number of years. But the discussion of annual exemption is in association to the loss. So what I will do, I will try to complete the explanation of annual exemption also, which will make all of us to work this question, which includes the losses and annual exemptions both together in. So for that reason, we also have to understand the annual exemption. What is it? How to deduct the amount of that, what it does. Annual exemption. Imagine there has been a sale of an asset for £50,000. The cost of the same asset is £30,000. And the cost, the gain that we have ended up working is 20. To make these gains taxable, the gains are exempt up to this much. This will make the gains taxable, means these gains are ready to tax, and we can apply the respective rates of taxes to it. 7,700. These gains are ready to tax. This is the annual exemption. The limit of that is fixed for tax year 22-23. Fixed. It will not be given to us in questions. We by default has to deduct. Without anyone has to say to us, we have to deduct. Annual exemption. It exempts the gain by this fixed figure of 12300. We were supposed to pay a tax on this, but now we will end up paying the tax on this. So this much of gains now have become tax-free, exempt. So it brings the level of gain down by 12300, which is a fixed limit. The second possibility is if we do have a case where the gains are not enough to absorb this. Suppose the cost that I have been able to subtract is 40,000 and the gain that I have found is 10,000. Now, the gains are not sufficient enough to come and subtract that whole of that amount. So what needs to be done in that case is, so we will be able to subtract the maximum. We will be able to subtract the maximum, the gains they allow us to. The figure cannot turn out to be a negative one. No. What is the gain that you have, the amount that we can deduct? Maximum. Any amount of the annual exemption that has not been relieved, it's called as unrelieved annual exemption. And this is going to be a waste. 12300 minus 10,000. This is going to be the waste. This much portion of annual exemption we could not possibly relieve equals to WASTE in big letters. Waste. Can't do anything about it. Because the benefit of that exemption is only limited to this only year. If this has been exhausted, fine. If not been, the remaining will be a waste. So any portion of the exemption which has not been used will not be carried forward. Like losses can be, this cannot be. The benefit of that is just restricted to this year only. If it has been taken, good. If it has not been, will be a waste. Okay. Another thing that needs to be looked upon in regards to annual exemption. What if there has been the disposal of two properties or two assets, not specifically properties, any assets, and randomly the proceeds of the disposal here are 40,000, here 30,000, the cost is 25,000, the cost here is 11,000, 15,000, 19,000. To make these gains taxable, we know that now this exemption needs to be deducted. But do we have to deduct this exemption this way? So don't get me wrong. This is an annual exemption. Annually, once available. Can't be using it. Can't be using it on asset by asset basis. You may have disposed 20 assets in one tax year, or you may have disposed one asset. Only one limit is made available. That means I will have to try and find the total of the two of those gains, which will be 34,000. out from which I will be deducting only once. That is another thing that you have to understand. I hope you may have thought of using this against each disposal. No, it's once, annually once available. It depends. Now you dispose 5 assets, 1 asset, just need to take that limit once. All of that being written over. Tax-free lump sum exemption. One exemption is available on all the disposals. The limit of that is this one. Any exemption that is not been relieved can never be carried forward, which in other words means is a waste. Anything that again has been written onto that page that's not been finished or that's not been covered, even on that previous page. So by the time you will end the chapter, you'll be feeling it like every corner of it, every page of it, every example of that, every heading of it, every picture of that has been gradually finished and you have not realized when. It's as if you're scanning it out, every bit of it. Application 4, let's do it, because this will take the losses and exemptions together within. A and B made the gains and the losses for the tax year 21 and 22, and intentionally I have provided the data of 2 tax years so that one will have a loss and then we will be able to carry it forward also to see how the way the loss will be carried forward and will be relieved. And there are 2 individuals and we must have to find the answers of the both separately. Let's start off with Mr. A in application number 4. And we will have to go in a chronological manner, means we will start off with 21, 22 tax year first, and then we will take 22, 23 afterwards. Providing to all of us with the gains and the losses. So the gains are provided, capital gains, and when we have losses, capital loss. 20,000 and 16,000. Because right now I'm into a year which is 20,000. See which tax year am I into right now? Am I into right now? Which tax year is it? It's 21, 22. This is the tax year that I'm into right now. This is the tax year that I'm into right now. So I will have to see the loss of this tax year to me must be called as current year capital loss. So I will go to write it very next to current year. Because at the moment, the tax year I'm into right now is 21, 22. So to me, this tax year's loss is called as current year capital loss. And I have been able to relieve it to get the figure of the gains against which, if I will think of deducting the exemption, that is the maximum I can think of deducting. The maximum I will think of deducting. Okay with that? That is a maximum I will think of deducting. And I've already told you that the part of annual exemption, if it does not relieve, that will be a waste. This will allow us to go into the next tax year where we will still have those capital gains. And the capital loss. Capital gains are 30,000 and 14,000. The figure that we have got is a figure of net capital gains. And once again, which tax year am I into right now? 22. So for to this tax year, it must have been a current year capital loss. Current year capital loss. And happily, I will be able to deduct the exemption this time around because the gains are plenty of to cover it. 12300. 3700. Okay with that. The sequence you cannot disturb has to start from the side of current year capital loss and then exemption. This question did not have any brought forward loss, but for Mr. B, you will definitely see the brought forward loss. So let's repeat that process of starting to deduct, starting to work from the side of tax year 21-22 and ending ourselves on 22-23. So they have provided to all of us with the data within which we have capital gains and capital losses. $6,000 and 11,000. Now, this time it will take us towards the brought forward loss. Check this out. First of all, which tax year am I into right now? I'm into this tax year. And the loss that has arrived in this tax year is called as current year capital loss, which I need to offset it against the capital gains. When I will go to offset it, this is the maximum that I can offset. So when I will come to offset it, this is the maximum that I can offset. Maximum. Any amount of the loss that we could not possibly relieve now will be called as, you know what, brought forward capital loss. This is the portion of the loss that we could not possibly relieve, and that will be now thrown into the next tax year. No annual exemption whatsoever we can possibly deduct, as the gains are zero. And now we will march towards the tax year 22-23. Once again, I will repeat the process of starting off writing the balance of capital gains. Next to that, we will have a capital loss, a current year one, and then the brought forward one. Now, for the first time being a part of this solution, we have brought forward loss coming to our way. And you'll be able to see the nice way of relieving, and then followed by an annual exemption to conclude the full and final answer of it. Now you'll be able to see the way the losses are carried forward, and we relieve them up in the next years. For Mr. A, We did not have any brought forward loss. We did not have any brought forward loss because the loss in the very first place was fully relieved. See, for Mr. A, the loss was fully relieved. The loss was fully relieved, but for Mr. B, 11,000 was the figure of the loss. 6,000 we could have possibly relieved, but 5,000 we could have not. This is the one that now we are taking it into this year. Let's go to, first of all, write the data of this tax year, 22,000. And then we have 8,500, the current year capital loss. In which tax year are we into right now? In 22-23. So that tax year's loss is called as current year capital loss. And you must have to always follow the sequence of relieving the current year capital loss before thinking of relieving the brought forward. So what is the figure that I have to fix it in? I have been able to. But this is where one last thing you have to understand in regards to the topic of losses. When the losses are carried forward, we relieve them against the capital gains of future tax years, which is what we are. But making one thing in check, that we should not be wasting the annual exemption of that tax year. The annual exemption of the tax year should not be hurt, should not be compromised. And it is compromised. Check. After deducting the two of those losses, what are we left out with over here? 22,000 minus 8,500 minus 5,000. It's just about 8,500 being left, which will not be enough to deduct the whole of that exemption. It means the exemption is compromised, which cannot be. Brought forward losses are carried forward, and we relieve them against the capital gains of future tax years to the extent that it should not waste the annual exemption. So the way to do that is what? Smart way of doing that is what? Is to write the exemption in advance like this, and then fill this up like a balancing figure. What is it? 22,000 minus 8,500 minus 12300. It's about 1,200. This is the max we could have possibly deducted. Any amount of the loss that's not been relieved, we can keep on carrying forward, because this carrying forward task is infinite. So even if some part of the loss still not been relieved, we'll keep on carrying the loss forward. This is what this one question had to explain to all of us. While you carry the loss forward, although you relieve it against the capital gains of future taxes, but you also have to keep the one thing in check, that it should not compromise the annual exemption of that tax year. Current year capital loss can, brought forward loss cannot. This discussion now I have done. Don't just start mixing it up with current year capital loss. For current year capital loss, I haven't said anything like that. Current year capital loss will fully be deducted, even if you're wasting an annual exemption or not. It's the brought forward loss which one has to look into in not relieving it just blindly. Take a look at it, that, okay, what amount is the maximum that I can fix it in, that even after fixing it in, I'm saving the whole of that exemption, which is 12300, 1,200. That point was written over. See, the maximum amount of the brought forward loss that can be relieved in a given tax year is restricted to the amount that does not waste that tax year's annual exemption. And to make sure, the way I have shown to you, you always can adapt that way. Write every figure in advance and fix this out to be as the balancing figure within. What amount of the loss that has not been relieved? 5,000. Out of 1,200 relieved, 3,800 has not been relieved. We will keep on carrying forward. This pretty much ends up the talk of the losses and annual exemption. And on that, the application number 14, we have even finished. You have not realized we already have touched the bottom. After completing all of that talk, we are here right now. The gains now have become ready to tax, and the time has come up. We tax them. And that is on the last page of the chapter to finish it off. So let's go to tax the capital gains. To calculate the capital gains tax liability, CGT liability computation, you must have to understand that from £1 to 37700, the rate of the tax is 10%. Any amount of the gain that goes up to that mark, the rate becomes 20%. This rate is a normal rate of capital gains tax. Normal rate. I'm making the heading normal rate. But if we come to apply the same rate to a residential property means house, apartment, flat, the rate will become instead 10, 18% and 28 instead of 20. And it's easy to do that. See, I'm going to write 10%. I'm going to write 20%. Just need to do that. Easy to remember. 10 will become 18. 20 will become 28. So if I have an asset that has been disposed in the question is a house, apartment, flat, cottage, villa, 28% will be applied. Residential property. That does not apply to factory building, office building, residential property. And normal rate is 10-20, which will be used in almost every scenario. And how to make the use of that? So in my case one, let's assume the taxable gains are 20,000. So they fall into a very first band, is it? So once the rate has been decided, so I will simply be able to apply 20,000 at the rate of 10%, 2,000. Okay with that? In case 2, if I can now make an assumption that the taxable gains are 39,000. So this 39,000 may have fallen into a second band, for surely have fallen. The rate has been decided and we will come to apply. No, we have to go limit by limit, that up to that mark, this much excess will only take 20%. So up to 370000, up to that point of mark, it is 10%. Only the excess will take 20%. So to find an excess, this way we can go. Write the total and take that as a balancing figure so that not to miss out any single pound in it. 37700 minus 39,000, it's going to be 1300. Good with that? So this way, this is 3770 and this is going to be 260. So the total that we have found turns up to be 4030. Okay with that? So if the gains, they fall into a first band, just choose the 10% rate and apply flat. But when the gains have fallen into a second band, needs to use the first full band at the rate of 10, only the access will take that 20%. It's called as basic rate of tax. This is called as high rate of tax. Basic, high. And for the residential property, the rates will only go to change to 18 and 28 instead of 10 and 20%. That's all written over here. 10% if they fall within that. 20 if they fall above. Also, they come and talk about the due date of payment. So it's easy to remember if the tax year is 22-23. If your tax year is 22-23, it starts on 6th of April 2022 and ends on 5th of April 2023. The due date for the payment of capital gains tax is 31st Jan following the end of tax year. 31st of Jan following the end of tax year. 31st of Jan following the end of tax year. Okay with that? 31st of Jan is the fixed date following the end of tax year. So if your tax year ends on 23, the Jan has to be of 24. That's even being written that 31st of Jan following the end of tax year. If the tax year is 22-23, this has to be by 31st of Jan 24. So see, everything in that lecture notes of this chapter been done and dusted, except this one last question is left, which will come to take all of the stuff we have done today in one. And we can do that just to revise it. The basic chapter of capital gain is going to come in about next 15-10 minutes. So let's go to work this question that says, compute the capital gains tax payable for the tax year 22-23 and state the due date for the payment. Stating the due date of payment for this tax year, I even can write it itself now. That should be 31st of Jan 2024. But finding the figure of capital gains tax is the real requirement, and we can do it. For the one last time today, Mike sold an investment property on this date for this much. He had acquired the building for 100,000 in March 2011 and has extended it at a cost of 20,000. Mike also has disposed of a painting, incurring this much of an auction fee. He had acquired the painting for 30,000 and had a capital loss brought forward of 19,000. Mike has taxable income of 15,000 in tax year 22-23. So it looks to me like a question we have done even before, where the two disposals were involved. So I will just adopt the same way of preparing the two columns, writing the data of each of the disposal into its own column, and then taxing them. We do have brought forward capital loss. And something that they have told in the last that never in the whole topic we have seen before. What is this taxable income of 15,000? So we will have to have a wait for it to see what is it. At least we can work the capital gain in the first place. Just 1 minute. Okay. So which application is it? The application number 5. Application number 5. And there are two things to look in. Two assets to be disposed. The first one is the property. The second one is the painting. So property and painting. On the left-hand side, we will have to go and rewrite the whole process of gross disposal proceeds. We have incidental cost. And then we have cost of acquisition. Have incidental cost of acquisition. And then comes the enhancement expenditure. The time has come up that we go and fix in the figures in one by one. Mike sold an investment property on the 1st of October 2022 for 700,000. The proceeds will come in front of proceeds. He had acquired the building for 100,000. Fine. And was extended at a cost of 20,000. Okay. Mike also has disposed of a painting on 1st of Feb for 10,000. Incurring an auction fee of 2%. Now that should be the incidental cost of disposal, must have been 200. He had acquired the painting for 30,000. He had acquired the painting for 30,000 and he had the capital losses being brought forward of 19,000. So we will see this loss thing in a while. But the rest, I guess, is all finished. We also have to notice the dates of disposal. The day the property was being disposed was 1st of October 2022. And the day the painting has been disposed is 1st of Feb 2023. So to which tax year the disposal of painting belongs to, and to which tax year the disposal of property belongs to? If you can remember your tax year, and if you cannot, I still can write that up there for your reference. Clearly, both the disposals, they belong to the same tax year. Yeah. So whatever the figure of the gain that you will find or the loss, both they will need to offset. Because one column I'm expecting to have a loss, since the cost looks to me like a huge figure in contrast to the proceeds. So definitely we're ending up getting a loss into that column, which will then be called as capital loss, current year capital loss. So 700,000, 100,000 minus 20,000, that's going to be 580,000. 580,000. And this column, the next one will have a loss, 10,000 minus 200. A figure of 10,000 minus 200 minus 30,000 should be 20200. People have seen me working a question. Okay. So you people have seen me working a question before where in one column we had a loss, and the other one we had a gain. So the same thing, we are finding it now over. The loss that has arrived in the current tax year we are into right now is called as the current year capital loss, and we have no way but to relieve it against the capital gains of the same tax year. So I can do that this way by bringing this loss very next to it into the same column. This is 20, 200. And then we have capital losses brought forward. For the capital loss brought forward, remember, we must have to keep an eye on the figure of annual exemption, not to waste it. And this technique of writing the exemption before will help always. But this time around, even we do not write the exemption in advance, the gains are plenty to cover the losses and exemptions. So we are safe enough to deduct all of the brought forward loss also. And the figure of taxable gain has arrived. The sequence you cannot change. It has to be a current year capital loss, then the brought forward capital loss, and then in the end, the exemption. So 580,000 minus 20200 minus 19,000 minus 12300. The figure turns out to be 528,500. 528,500. Now this figure of the gain is called as taxable gain. And now we are ready to tax, which is what in that question they had asked. Quite many times this pro forma in this one course, people have seen me preparing. So I told you by the time this chapter will come to an end, you'll become so comfortable with this top to bottom pro forma, all those contents into it. Many times in the same course, people have seen me revising current year capital loss also, brought forward capital loss also, and that exemption thing in the last. No one has asked me to deduct that exemption. I by self needs to deduct it. So that level of gain looks to me falls into a second band. It's a huge amount of the gain. So up to 37700 mark, the rate of tax will be 10%. Access will be at 20%. As this is an investment property. An investment property is not a residential property. It's a business property. You suppose you have a building which you have acquired with the intention of letting it out to someone to get rentals back on. So that's your business. It's not the residence of yours that you live in by yourself with your family. It's the property you have acquired so that you later let that out to get back the rentals from. It's your business asset, not a residential property. So you're not going to use that special 18-28% rate for that. The second one itself is a painting, so that's still going to follow that normal 10-20% rate. So I can write those band limits once again for your reference. £1 to 37700, the rate of tax will be 10%. Anything that goes up to that mark, the rate will become 20%. One important thing that in this question that they have provided to all of us for the very first time is this 15,000, and we need to understand what is it and what is the impact of that in the question of capital gain. See, the question provides to all of us with taxable income of 15,000. Now, this is an income, not a gain. This income is subject to income tax, which is a topic we right now are not in debate of. This is the topic we right now is not in the debate of. Then what's the point that this question provides to all of us with this piece of information? We're not learning the income tax at the moment. So why the question provides us with this income of individual at the moment? Although we are not learning income tax, and we are not even calculating income tax, and we will not even, but we still have to make the use of that income while computing the capital gains tax. How? See, I'll go and make a timeline, and on that, I'll try to plot these band £1 to 37700. The rate of tax is 10%. Anything goes up to that mark, the rate becomes 20%. These band limits are available once every tax year to each person. Once means if I'm an individual, I must have to make the use of these band limits to tax my incomes and gains both from. To tax my income and gains both from these band limits, not separately. These limits will be provided to me when it comes to taxing my income. I have been provided with these limits once in that tax year. So I must have to make the use of these limits to tax both of my income and the gains. And in the sequence, these limits will be exhausted by the income of individual, used up by the individual income of individual. So let's go to plot it that by about 15,000 amount. The limit has been exhausted. The limit has been exhausted by the income of individual. By the income of individual, it has been exhausted. This much cannot be used for capital gains. And if I have to start taxing the capital gains, I have no choice but to start counting it from this point of mark to this. This is the portion of the band which has not been used and now will be used for capital gains. So although we are not taxing income, but at least based on the figure of income that they have provided, I know that this much portion of the bands had been exhausted by the income of individual, and the remaining amount is the only amount that I can use that for the capital gains within that first limit. Obviously, the next limit is fully available, but within the first range, I will only be able to use 37700 minus 15,000. And that's going to be like 27700. So the amount of capital gains that they fall in will be taxed at 10 and access will be taxed at 20%. Let's do it. So up to 22700 mark, the rate of tax will be 10%. Access will be at 20%. And to find the access, go and write the total down below. And take this a balancing figure. 528,500. This is 505,800. The figure of that is 101,160. Two two seven double zero. The rate is 10%. 2270. Okay, so a little bit of thing which you need to consider, because sometimes the question provides with this piece of information, so you have to respect it, that why all of the sudden, where we are performing the question of capital gain, where they are wanting me to calculate the capital gains tax, then they have provided me with this piece of information. What's the whole use of it? Now you even have seen the use of it, that income will come to exhaust these band limits first. That means this much of the side of the band limit will no longer be used for capital gain. And if I have to tax the capital gains, I only have this much to take it from. The amount of capital gains that they fall in it will be taxed at 10. Access will be flat 20, which is what exactly I did over here. Pretty much ends up this first basic chapter. The pro forma from A to top to the bottom, the treatment of losses, the current year, the brought forward, the exemption, the treatment of incidental cost, the treatment of cost of acquisition, the disposal proceeds, and to which tax year these gains, they belong to the tax year. All what we could have done being the part of this first basic chapter of capital gains, we have been able to finish. Not a single thing you can take out of this chapter that you believe that I have not been able to touch, or I have not finished, or I have not looked upon. Every page of the chapter, now you can clearly see in the end, has been marked, has been underlined, has been highlighted, suggested that not just we have been able to complete the board work of ours, but also we had made sure that the lecture notes have been well looked upon. The course of today has given you the actual a sense of the way that I deliver a course. I conduct all of my lectures, my lecture notes, the live course explanations, the way that I present myself into a course, which the last week probably not many of you could have guessed it, because last time we were just talking about some information stuff. And this is the topic of the capital gains that now you would expect to see for all the next 5 sessions to come. Chapter 17 has all been done. Now, chapter 18, if you look into the start of it, focuses on shares and securities. We're still on capital gains, but this chapter will talk about the disposals of investments into stocks and securities. We will not come to see property, plant and equipment, motor cars, buildings and all. We'll rather come to see the disposal of shares in it, the disposal of bonds in it, the disposal of other securities into it. In the intro part, they come to give us the same reminder of that almost every disposal of shares and the securities are taxable. May it be a quoted one or an unquoted one, unless they are exempt. And exempt assets are, remember, the same 4 of them. Itself, in the start of the course of today, I was trying to make you remember that investments into new individual savings account, investments into national savings certificates, investments into the government stocks, and investments into the qualifying corporate bonds are in fact the same 4 exempt products. We have had a look onto it before, and if you are not believing into me, I can show to all of you. Exactly these investments have now been taken to that chapter, because that chapter only focuses on securities and shares. So we are going to take just these 4 products into that chapter, not motor cars and rest of the exempt items. So the start of the chapter is never a surprise when you're coming from the chapter 17 and you already have remembered that list of exempt assets. Then these 4 products are in fact the products we have covered while defining the capital gains tax topic in chapter 17. The government securities like gilt-edged securities, which is also called as gilts, treasury stock, exchequer stock, qualifying corporate bonds are the loan stocks, debentures, shares held in individual savings account, and national certificates. Which of the following shares and securities are exempt and chargeable? 15% preference shares in a quoted company. Shares can be the quoted one, shares can be the unquoted one, shares can be the preference one, shares can be the ordinary ones. They are definitely chargeable. Exchequer stock, no. Why? It's a government security. Loan stock, no. Why? It's a qualifying corporate bond. See, the loan notes, debentures are bonds, qualifying corporate bonds. 50 pence ordinary shares in an unquoted. I told you, ordinary, preference, quoted, unquoted, chargeable. So in the start of the chapter, even they come to remind us all that, look, these 4 types of investments are exempt. Other than that, any investment you will find is automatically chargeable. This will be the topic of ours for the next Saturday course. It's a small chapter. This chapter will be finished in about 1.5 hours. Probably in the first half of the course, we will be able to finish, and then we'll be able to start off with chapter 19, the same course in the next Saturday slot. See, the course has started. 2 sessions have already been done, and we have not realized how quickly. And this how the next 4 months, less than 4 months, will even expire. About 17 to odd sessions we have. You just have to keep on participating, coming into the live sessions the way that you are, with the positive mindset, with all that motivation, with all that commitment. And once you take a course, after that, you have got all the week to revisit it. At least the board work, we can visit it, if not the recording. You have got this board work, and you quickly can revise by spending 30 minutes odd on before coming into the next course. See, I always say to the students, it's a 3-hour course. And to get the better benefit out of this, just plug in the further 30 minutes in to make it 3.5 hours. These 30 minutes are your revision of that 3-hour course, completes the package. What happens when you do not plug in this 30 minutes of your revision with that 3-hour course? This way you waste a lot of thing into it. But by plugging the 30 minutes to that 3-hour course, you take a whole good complete pack of it. Every time you come into a course, it's the continuation of previous course. Means what we have done today, it's not the end of it. We'll keep coming to our way and will help you in live sessions when you will come up into a course by revising yourself with. Being a student, after 6 days, you definitely will forget. Unless or until a night before, a day before, even a Saturday morning, the course is planned in afternoon, plenty of time in the Saturday morning that you have. Just can take 30 minutes, 40 minutes, 45 minutes of yours life to visit this whiteboard explanation. This will bring you back into a same momentum that right now you are in. And easy the life of yours will become to start the very next course. Last time I've instructed you a lot that few of those things, if you will respect, small things, every little thing will count towards the better preparation of yours. This concludes the course of today. I will see you with the continuation of the capital gains tax topic into our next Saturday course. Have a good weekend. Thank you very much.